People everywhere keep asking, why is everyone worried about stocks? Debt's exploding, valuations are above dot-com levels, consumers are straining, and the AI hype is doing all the heavy lifting. Today, I'm going to break down the past, the present, and what disciplined investors should do about it. So guys, imagine waking up tomorrow morning. You grab your phone and the headline said, market's down 30% overnight. Can you honestly tell me what you would do? At face value, stocks look unstoppable. S&P is climbing. When it does go down, it comes right back and it hits new all-time highs. And every single day, we hear about the new hot tech stocks. But investors in the know are getting nervous, and they're asking a very important question, one that they're absolutely dead right to be worried about. The question is, are we in a bubble? And that's exactly what I want to walk through today. Why are people worried about stocks? What does history tell us about past bubbles? What today's valuations and fundamentals is saying? And most importantly, what investors like you and I should be doing about it right now? This is not about panic. It's about facts, fundamentals, and most importantly, discipline. Everyone has the brains to be successful at investing. Not many people have the stomach. So let's start with number one reason why people are or should be worried: valuations. Now, the second biggest ratio I always talk about is the 10-year cyclically adjusted PE ratio. Forget about that fancy word. What it means is it takes up the last 10 years of earnings, brings it to today by smoothing it out with inflation, and divides the stock market price by that. Now, historically, we should be around 17 and a half on the high side. And over time, it gets bigger because as we become more tech heavy, it takes less capital to increase profit. But right now, guys, we're at almost 39. That's 120% above the historical average. The cash flow is the same, but the price you paid relative to history says to me that your returns are likely to be worse. When? We don't know. We never know. Now, let's look at another one. The Buffett Indicator. This has been made famous by Warren Buffett as the single most reliable metric of stock market valuation at any given time. It compares the total value of the stock market, all the companies together, put all their market caps together, and divides it by GDP. Now, this makes sense because in an economy, all the companies in there should make up a certain percentage of the GDP. So where are we right now? The 10-year PE was 120% overvalued. Good news. This indicator is less overpriced. It's 117% overvalued. It's still insane. What this means, guys, is investors are paying more than double what the historical average for the economy should be. And here's where it gets even more concerning. The market is not rising evenly. Almost all the returns are being driven by a small group of companies, the so-called Magnificent Seven: Apple, Microsoft, Google, Amazon, Nvidia, Tesla, Meta. If you take them out of the equation, the market doesn't look nearly as strong. This concentration is extremely dangerous. In history, this happens at major bubble peaks. These small group of companies really drive the charge. Why is this dangerous? Well, guys, these 7 companies make up like 39% of the entire S&P 500's value. So what happens if they all start to crack? What happens if only 2 or 3 of the largest ones start to crack? Suddenly, the entire index will look weaker. This is why I say that it feels like the year 2000. Back then, it wasn't the great financial crisis 08 banks. It was valuations that were out of control. Back then, it was .com driving the hype. What is it today? It's AI. And guys, we've seen some bubbles burst. We saw electric vehicles burst. We saw the cannabis burst. We see these things all the time. Now, let me show you what I mean by this. The biggest company in the S&P 500 is Nvidia. This is what's crazy about this market. $4 trillion company. And look at this. In the last 1 year, it has been as high as $185 a share and as low as 86. That's an increase over 100% for the world's largest company in less than 1 year. So what is this company worth? Well, guys, first off, I'm going to tell you something. This is an incredible business. I don't care what anybody says. It's an incredible business. But our fifth and most important tenet of principle-driven investing is a great story can become a bad investment if you pay the wrong price. And what you're saying when you buy Nvidia, no matter what price it goes to, or any investment for that matter, is no price is too high. but I know you've made it far enough in this video to realize that you're probably not that kind of person. You probably want to understand what you're buying. And when you buy a stock, you're buying a piece of a business. What's the NVIDIA business look like? Well, I'll tell you, it's incredible, but it's highly reliant on AI. And AI is going to be big for the future. But they just came out with earnings just last week, and it showed that 23% of their revenue last quarter was from one customer. That's a lot. If that customer just pares back 20 or 30%, what would happen? Now, is that likely to happen? I don't know. But when you're buying a company based on the rosiest of outcomes, that's kind of scary. So let's see what outcomes I have considered for NVIDIA. So guys, I did a 10-year analysis in our stock analyzer tool. This is where we go. And this is the reason why this tool has been used millions of times every year. We take the story and the numbers, we put them together. I took NVIDIA and I said 10, 15, 20% revenue growth in the next 10 years. Guys, that's a lot. That's a ton. You might not think that's a lot because it says 15%, it's not a ton. It's a ton. I put profit margin, 35, 42, and 49, both profit margin and free cash flow. What PE would I sign this in 10 years? Well, guys, if they grow like this, incredible business. I put 20, 24, and 28. They're currently at 48 and 58. That's a lot, even for a great growing company. And finally, 9% value, desired return. I'm just trying to figure out what's this company worth to me today. If it were to sell on the market at the market valuations, what would this make it worth? I hit the analyze button, and guys, here's what I have. I have a low price of 73, high price of 290, middle price of 150. And it's currently at 170. So it's not far off if you believe my rosy assumptions above. 15% revenue growth was my middle assumption. This company has done incredible, and it's grown into its value time and time again. Let's not forget inflation. If inflation is running high, even stocks that are hitting all-time high in nominal returns, in real terms, that means taking inflation out, your wealth may not be growing as much as you think. Now, with that said, with inflation, their revenue is likely to grow faster. But here we are looking at the world's largest company, and we're seeing overvaluation. We're seeing it the market returns were without these large companies, and it was basically not very good. So the 493 other companies in S&P doing these 7 are driving the charge. So the question is, are stock prices really reflecting real after inflation earnings, or are they disconnected from reality? Now let's talk about history, because every time there's a bubble, people in the middle of it will say some variation of this time it's different, and every single time it's not. And then after the fact, they look back and say, it was clearly stupid. Really? That's funny, because in the middle of it, when we said it was stupid, we were told we were fudsters, we told we were negative, we missed the boat, blah, 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 blah. Guys, in 1929, it was leverage. People borrowed tons of money to buy stocks on a margin because stocks just went up. The bubble burst, the Dow went down 86%. The entire economy collapsed, and we entered a 12-year depression that we only got out of because of a world war. In 1987, it was portfolio insurance, this fancy new strategy that was supposed to prevent losses. And instead, it triggered automatic panic selling. In one single day, the market dropped 22%. In 2000, it was a dot-com mania. Companies with no earnings, some with no revenue at all, were selling at insane valuations. Why? Because internet is going to change the world. It's new, it's different. This time, it's different. In 2008, it was housing and banks. Subprime mortgages, risky lending, too much leverage. Similar plot lines, different villains, different characters, but one constant: valuations matter. And here's the key. Today looks a lot more like the year 2000 than 2008. Back in 2000, it wasn't the economy, it wasn't the banks. It was sky-high valuations built on hype and euphoria. Does that sound familiar? Yeah, it's AI, and AI will change the world. A bubble is built on a good premise, and then it gets exaggerated. Guys, AI is so powerful, it's unbelievable. But the question is, what's the right price to pay for a future stream of cash flow? That's the question you need to be asking when you buy a company, when you buy any sort of investment, stock, real estate, bonds, anything. Are today's prices based on that future potential earnings, or is it based on some hype and hope? And here's the tricky part. Bubbles can last and will last longer than anyone thinks. As John Maynard Keynes famously said, the markets can stay irrational longer than you can stay solvent. I always describe a room filled with gasoline that I heard from John Hussman. There's a room full of gasoline. There's a fire in the corner, a fireplace going. We don't know which spark will cause the explosion, but guess what? There will be a spark that causes the explosion. It could be interest rates, it could be geopolitics, it could be some random earning, it could be any sort of a million things. Sooner or later, somebody's going to light the wrong match. And let's be honest, that's what makes timing impossible. You never know when, but you do know this. The more you pay for an asset, the less your returns will be. Think about that logically. If I were to give you $1 per year the rest of your life and you paid me $1 million for it today, you're going to lose a lot of money. If you pay me $1 for it today, you are going to make a very high return. The dollar future return is still the same. Whatever you pay for NVIDIA, the company doesn't care what you pay for the stock. They just care, how do I get more customers? And they're going to do that. The question is, what will you pay for their future sales and profit? Now, here's something else that people don't realize. Even if you bought at the absolute peak of the dot-com bubble, but you bought a diversified group of great companies like the NASDAQ QQQ, it fell over 80%. But if you stayed disciplined, if you kept dollar cost averaging, you would have made upwards of 14.5% annualized today, starting at the peak of the dot-com bubble back in 2000. Think about that. You literally timed it 100% incorrectly, and discipline still paid off. Now, let's move on from valuations, talk about the real economy. Because at the end of the day, stocks do not exist in a vacuum. They are going to reflect the economy underneath. If I told you suddenly the economy is going to fall 50%, which that doesn't happen, even in COVID it only fell 34%. But let's say it were to fall 50%. People are going to spend a lot less money. Companies are going to make a lot less money. Companies are going to go under. Stocks should go lower. And if you look at the headlines, things don't seem bad. And by the way, I'm not a believer that things are poorly done out there and we're headed for disaster. Not at all. But things aren't as rosy as we think. We still have GDP growth. In fact, it was 3.3% annualized as of last quarter. Unemployment, still 4.2, 4.3%. Incredibly low. Companies are reporting earnings and many of them are beating expectations. But here's the problem. Everything is rosy when you start to see the cracks though. Think about it like a house. From the street, it might look great. Fresh paint, new landscaping, but the foundation's cracked. If the plumbing is leaking, if the roof is leaking, you won't see that from the outside. That's what the economy feels like right now. How so? Well, for one thing, credit card balances and delinquencies are up significantly. Delinquencies on mortgages over 30 days are up significantly. Delinquencies on car loans are up insane amounts. And guys, these are things that people need. That's what worries me. We're not in this foreclosure route. We're not in any of this thing happening, but those are cracks where I go, that's a problem. Now, inflation, it's cooled off, but it hasn't disappeared. Prices are still high. Grocery bill is still higher than it was 2 years ago. Rent is still climbing. Gas is still higher. For everyday people, the pain has not gone away. Their incomes have not caught up to those increases they already saw a couple of years ago. On paper, the consumer spending is holding back. And guess what? Consumer spending is 70% of GDP. And if you look a little bit closer, a lot of it is going to essentials: food, energy, housing. People are using credit cards more than ever before to keep up. Savings rates are collapsing. That's not healthy. Whenever we borrow money, we're taking away from tomorrow's growth, especially when you do it with credit cards. So the question becomes, are people spending because they're confident or because they're forced to? There's a big difference. I get worried when people are borrowing money for essentials. Yes, it's not good to borrow money to buy an expensive watch, purse, or any sort of luxuries. But if you have to borrow money to buy your essentials, things are pretty tight. So yes, GDP is growing. Yes, unemployment is low. The cracks are there. But guys, not being a fudster here, I still think the US has the best future ahead of it. I will absolutely say that like Warren Buffett does. I want you to know that even though things look rough on valuations, there's still opportunity out there. The economy, there's still going to be opportunity in the economy. In fact, there's more opportunity as time goes on. So let's zoom in from the economy as a whole down to that consumer. Because remember, as I said before, US economy is 70% consumer spending. If the consumer is strong, the economy can still keep growing. But if the consumer gets weak, there's going to be more cracks. Like I said before, credit card balances are record highs. This isn't just more spending, it's more expensive spending because those interest rates north of 20%, they're borrowing today and then paying for it for a long period of time. That means people are borrowing money at essentially loan shark rates just to buy groceries or pay bills. That's not healthy, guys. That's survival spending. And where's the money going? It's not going to discretionary items. It's not vacations, restaurants, luxury goods. And guys, this is showing up in retail numbers. We've already seen a lot of major retailers like Target, Home Depot, Lowe's. Those guys are showing same-store sales declines. But Walmart, the money-saving place, they're sitting there seeing increase in sales, but still warning that the consumer is pulling back. So are falling retail numbers just noise, or are they the canary in the coal mine? And here's where it gets tricky. Inflation is cool on paper, but people don't live on paper. They live in the grocery store. And the egg that cost $2 2 years ago and they're $4 now, even if inflation goes to zero, it's still $4. It just means it's not going any higher. That price jump doesn't reset. It sticks, and that's what people feel. Now, guys, we've seen the government print a lot of money out there. And what that does is it increases inflation in the long run. And when it also increases inflation, what did the government have to do to keep that tempered? They got to raise rates. So guys, if we have higher inflation and we're taking away from future growth, that's stagflation. That's what happened in the 1970s. Stagflation is not a good thing to have. You have little to no economic growth plus higher costs. So people at home are going to pay more money, but not get the raises they need. That is not a good scenario for investors. And if you look back to the 1970s, we saw from 1966 to 1982, stocks went nowhere. The S&P started at 110, finished at 107. Valuations also. Valuations were high in 1966. In fact, so high that Warren Buffett closed his investment fund down and said, I have no good investment ideas out there. So he shut it down and gave everybody their money back. Are we there right now? No. Is there a guarantee it's going to happen? I mean, guys, I'm not going to lie to you. I thought we would hit a recession. We did not. So could we get ourselves out of this mess very easily? Not very easily. But the idea of printing all this money and it not costing us, it seems difficult. In 2008, we printed a lot of money, but we didn't put it in people's hands. Now it's a little bit different. So guys, when you take valuations and you take the fact that we're off one of the strongest economic booms in a long time, you sit there and say, well, what if the economic boom does not continue? Nothing lasts forever. Good times don't last forever. Bad times don't last forever. That's the good news when things are tough. But when things are great and valuations are stretched, though, you got to be cautious. So what do you do about it? This is where everyone gets it wrong. They panic. They go to cash. They try to time the market. But the truth is, you don't need to predict the crash. You need a process. This is where people get hurt. They chase hype when things are going up, and they panic when things are going down. And in the end, those people always lose. So here's how I like to think about it. First, I can get 4.25% on a 90-day treasury bill guaranteed. So why would I buy a stock unless I think I can get a huge margin on that? That is my major hurdle rate. If I'm not confident stock can deliver well into double-digit returns, I'm not going to touch it. But I'm still going to dollar cost average into my low-cost ETFs because I want to take the thinking out of my investing. Second, whenever I do buy a stock, I'm always going to go to value. Companies with strong cash flow, great balance sheets, and a margin of safety. What I mean by margin of safety is getting that high double-digit return. Where? 12 to 15% depends on the situation. That's where wealth is built. Wealth is built into dollar cost averaging, into low-cost ETFs, and buying great companies at great prices. Third, I like my hedge. For me, it's gold miners. I've said it before. I think they're going to actually outperform the S&P in the next 10 years. And guess what? It's done very well in the last 2 years exactly off that. When I was buying gold miners at gold at 1700, I was ridiculed. Oh, you can't make money in gold. I'm like, I'm not trying to buy gold. I'm buying the gold miners because there's a disconnect between their cost to mine the gold versus the cost of the gold in the market. And that margin is the highest it's ever been. They can be volatile, but they're definitely a hedge against inflation. They're definitely a hedge against currency debasement. They're not Bitcoin. And finally, and the most important rule, never try to time the market. Dollar cost average. You buy week after week, month after month, whatever timeline you want to pick, no matter what the headlines say. So guys, the bottom line is this. Markets are dangerously overvalued. I have no problem being a futster by saying that. They are absolutely dangerously overvalued. Debt is piling up at a rate that cannot continue. Consumers are stretched thin and there are sparks flying in a room full of gasoline. Just nobody knows which one's going to light the fire. But here's what I do know. You don't need to predict. You don't need to panic. You need a process. And because bubbles always pop, the question isn't if, it's when and whether you're prepared. This is why I tell you consistency beats clever. The guy who quietly keeps dollar cost averaging will beat the guy trying to time the market every single time. So if you want to see how we actually analyze value stocks, how we break them down against today's hype, click the video on your screen right now, because in that video, I'm going to walk you through our whole process step by step. And I want you to do me a favor. I have 5 tenets of principle-driven investing that will allow you to think about investing in a certain way, in a way that doesn't worry about the numbers, worries about the mindset, which is the most important part. Principle-driven investing is something I believe in, that I created. Click the link below, 100% free. It'll be in your inbox in less than a minute. Thank you for your time.